Jim Chanos is selling well-established brick-and-mortar legacy data centers because the largest cloud providers, Amazon Web Services, Google Cloud, and Microsoft Azure, are building their own data centers instead of leasing from REIT-owned infrastructure. He believes many of these REITs and companies are overvalued and are on the cusp of experiencing a slump in revenue and falling earnings growth. To put it another way, the three largest customers of brick-and-mortar data centers are becoming its biggest competitors. Iron Mountain is one of the brick-and-mortar data center companies Jim Chanos is shorting. This video outlines Iron Mountain's operations, financials, equity analyst expectations, and our thoughts on its value. Iron Mountain Incorporated, founded in 1951, is the global leader for storage and information management services, trusted by more than 225,000 organizations around the world, and with a real estate network of more than 90 million square feet across approximately 1,450 facilities in approximately 50 countries. Iron Mountain stores and protects billions of valued assets, including critical business information, highly sensitive data, and cultural and historical artifacts. Providing solutions that include secure record storage, information management, digital transformation, secure destruction, as well as data centers, cloud services, and art storage and logistics, Iron Mountain helps customers lower cost and risk, comply with regulations, recover from disaster, and enable a more digital way of working. Iron Mountain had an impressive first quarter 2022 earnings. Its net income of $42 million was a record quarterly revenue and adjusted EBITDA. Organic first quarter storage rental revenue growth of 6.8%, reflecting continued benefit of pricing combined with positive volume trends and data center growth. First quarter adjusted EBITDA growth of 13.3% year over year. Total global volume up 2.3% year over year at 728 million cubic feet. Its global data center team leased 35 megawatts in the first quarter. Looking at its first quarter revenue numbers and dissecting them a little bit, we see that storage rental revenue had a year-over-year increase of 6%, while service revenue had a year-over-year increase of 33%, with a total revenue increase of 15%. We can also see here that we look at a net loss, which is somewhat usual, but adjusted EBITDA is at 13%. Adjusted EBITDA margin is down about 70 basis points. The balance sheet is also looking good, with approximately $1.8 billion of liquidity, around 81% fixed rate debt, 4.5% weighted average interest rate, and 6.8 years weighted average maturity. Finally, looking at the net lease adjusted leverage, Iron Mountain is roughly 80 basis points below the JP Morgan REIT composite, which is at 6.2 times, whereas Iron Mountain continues to focus on an attractive capital allocation program. It is investing across all businesses to drive growth. It currently is approaching its long-term target AFO, which is low to mid-60s. And once that is reached, they plan on growing the dividend in line with AFO. Its current long-term target leverage ratio is currently between 4.5x and 5.5x. Iron Mountain continues to show large amounts of strength in its data center makeup. They've had their most successful quarter of leasing in its history at 35 megawatts, including an entire 27 megawatt facility. It achieved organic storage revenue growth of 26% in the first quarter and signed a 72 megawatt near build to suit lease in Virginia in April, increasing leasing target for new expansion leases from 50 megawatts to 130 megawatts for fiscal year 2022. Iron Mountain gave guidance back in April 2022 for the remainder of the year. It sees total revenue exceeding 14% year-over-year change. Its adjusted EBITDA is looking to climb anywhere between 10% to 13% year-over-year. AFO is also looking to see that jump 7 to 11% year-over-year. And AFO per share is looking to be somewhere in the ballpark around 6 to 10% year-over-year increase. The outlook for the second quarter is also positive. They expect strong growth trends to continue with revenue, adjusted EBITDA, and AFO of approximately $1.3 billion, $450 million, and $260 million. Let's see if they can hit those numbers. There's been little analyst coverage for Iron Mountain. Stifel upgraded the stock from hold to buy back in February and set a price target of $52, and that's up $3 from the previous ratings announcement. Barclay also initiated coverage and announced an overweight and a price target of $58 a share. Zacks currently has a strong buy rating for the stock. The funds from operations per share is the main reason why Zacks has a strong buy rating on the stock. The FFO has significantly increased 22.3% over the past 2 months to 3.78. It also holds a record for announcing dividend increases for 9 consecutive years. Iron Mountain will be an attractive buy if its stock price comes down. It currently has a decent level of institutional ownership, and there's no big reason to think that the institutions will start dumping the stock unless it has been materially lying about what's going on within the company. The strength of the dividend also seems to be intact and should continue to be intact during its aggressive operations push. The main reason why we would not buy the stock right now is because it's not clear on how well they're going to be able to compete against the big three when it comes to fighting for market share in the data center brick-and-mortar segment. That will be all for this video. Thanks so much for watching. Please hit the subscribe button and the like button so that we know that you are enjoying the content. And please leave a comment letting us know what other types of videos you'd like to see. Thanks so much for your time, and have a good day.